Before that, Anand Tandon of JRG Securities is also joined in. Anand, morning. What are you expecting from the Reserve Bank on Thursday? How is the street poised to take that communication, you think?
Well, first of all, Udayan, let me congratulate you on your birthday. I think it's today.
Thank you.
So many happy returns and many bull runs ahead. And in that vein, I would think that, the RBI is unlikely to do anything exceptional this time. So, the street's expecting 25 bips. I think you'll probably get that much.
And good morning. The answer was because of Udayan's birthday, or that's what you think?
Well, I think, you can't expect two surprises, because then it becomes a habit to expect surprises, and then it's no more a surprise. So, I think most central banks today are in the game of trying to keep the markets guessing, and therefore, this is kind of double jeopardy that you're trying to play.
Anand, what do you make of Reliance now? All this news swirling around, would you buy it as a contrarian pick or still stay away?
I think it's a company which is not going to just vanish and go away just because of some pressure from a certain set of reports. I think the challenges are a little more internal in terms of being able to pump up the gas volume from the KG basin. If that were to happen, I think you would find that the stock would rally anyway. Even otherwise, it seems to be in a fairly sweet spot with regard to its the petro cycle. And therefore, at this valuation, I don't think there is much to lose. Even though there is a season of having many corporates being investigated by the government or various other investigative agencies, I doubt whether Reliance will be one of those which will fall in that trap.
How are you feeling about the global setup, Anand? And if this were to get to be, a deeper cut or a rougher summer, do you think India can actually hold out the way it has these past few weeks?
Well, actually, India on a relative basis hasn't done very well. So, it's not as if there is a lot of money coming in anyway. Globally, obviously, the markets, at least the economies are in worse shape than they were, let's say, 6 months ago, or at least getting into this current year. I think most economies, both European as well as the US, are not showing any signs of great strength. So, there isn't that much expectation built in from emerging markets, to the extent that money may actually move out a bit more. We're already at roughly, $200 million in the current calendar. So there isn't much that you can look at people getting out. The other part that's on the retail side in the Indian market also, there hasn't been much participation. So the downside to me looks a little somewhat capped. At the same time, we are beginning to get a sense that a lot of players are beginning to look at the mid caps from a valuation point of view. And while the valuations are no doubt attractive, the fact of the matter is that the mid caps are not likely to be moving the market anytime soon. So if you have money, look at the mid caps from the point of view of parking some, and hopefully if you get in cheap enough, you'll make some money over the medium term. But otherwise, you really have to wait for the market to turn, and that can't happen before another 6 months at the very least.
It's falling less though, Anand. I mean, even over the last couple of weeks, India and China clearly stand out as two markets who are getting cut less than the others. What about the reverse psychology that money starts coming in rather than the fear of money going out?
That's a little more challenging, because you have a situation where there is growth which is slowing down, as you mentioned. The IIP numbers for April showed you that the growth rates are lower than what the consensus of the street was at. And even though we've seen that excise collections are high, as the man said, it's more likely to be a follow through from the last fiscal than anything to do with the current fiscal. So therefore, slowdown in production, margins still somewhat under pressure, and valuations which albeit are better than what they were earlier, are still not necessarily in the cheap range. Interest rates which are likely to still head up a little more. Not a great macro setup for the market to have a runaway bull run. As I said, the second half, some of the things could change. Commodity prices could be lower. You may have margins beginning to set up again, and expectations of growth may have narrowed down even more in a manner that allows you to look for a better setup in the market. So broadly, I think you can start looking at the equity markets now, but don't expect any dramatic move up, and I don't therefore expect any money to come in a gush.